Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, can a solo 401k invest in stocks? This is your chance to also get answers. Go ahead and type them over. They can be questions surrounding today's topic or anything else regarding solo 401ks as well as self-directed IRAs. Go ahead and type them over. We will pause and answer those questions as they come in. So for now, let's get started here. So can the solo 401k invest in stocks? Yes, a solo 401k can absolutely invest in stocks. In fact, investing in stocks, ETFs, mutual funds, index funds, CDs, and bonds are very common uses of a solo 401k. But what many self-employed business owners don't realize is that how your solo 401k is set up determines what else you can invest in beyond traditional equities. So we're going to break this down. Let's see if we have any questions. My first time here. Is this the place to post my questions? That's right. Go ahead and type them over and we'll answer questions as they come in. In the meantime, let's continue here. So what is a solo 401k? A solo 401k, also called a one participant 401k, is a retirement plan designed for self-employed individuals. So owner-only businesses. Businesses where only owners and their spouses are working in the business. However, if you do employ non-owner W-2 employees in the business, you can still open a solo 401k plan, provided that non-owner common law W-2 employee does not work 1,000 hours or more in your business or any business under your control. You can always exclude contractors. So if your business hires contractors, regardless of how many hours they work, they can always be excluded from the plan. Anyone under age 21, regardless if they're a W-2 employee or a contractor, and if they work full-time, can also be excluded. So as long as you meet these eligibility requirements, you would qualify for a solo 401k. Solo 401k plans follow the same IRS rules as traditional 401k plans, aka full-time employer 401ks, but the solo 401k is structured specifically for owner-only businesses. So yes, as I mentioned earlier, a solo 401k can certainly invest in stocks. Typically, there are two different variations of a solo 401k. There's the standard, aka basic solo 401k plan, which allows for investing in equities like individual stocks, exchange traded funds, mutual funds, index funds, certificates of deposit, bonds, treasury securities. And then there's the self-directed solo 401k plan, which also allows for investing in the above mentioned type of equities. So if you open a solo 401k directly with brokerage firms, whether Fidelity Investments, Charles Schwab, E-Trade, other brokerage firms out there, you typically get access to these traditional equity and fixed income investments. Well, for many investors, this may be sufficient. That is, being able to invest that, aka basic solo 401k in equities. But for entrepreneurs and advanced investors who want more flexibility, there's another level. And that's where the self-directed solo 401k plan comes into play. So a self-directed solo 401k gives you the ability to invest in both traditional equities as well as alternative investments. This is where structure matters. For example, when you open a solo 401k that's provided by a self-directed solo 401k provider like my solo 401k financial, the plan is drafted to allow for broad investment authority, including alternative investments, while still letting you use major brokerage platforms for your stock investments. So this means you can still open the brokerage accounts for the self-directed solo 401k offered by my solo 401k financial at a brokerage firm like Fidelity Investments or Charles Schwab, for example. Both of these firms would act as custodians and therefore provide the brokerage platform. The investment authority, however, comes from the plan document provided by my solo 401k financial, which names the business owner as the trustee of the plan. So this is a critical distinction because it's going to impact what can be done under that solo 401k plan, including being able to invest not only in equities, but also alternative investments. So with a properly structured self-directed solo 401k, you can invest in traditional investments, stocks, ETFs, mutual funds, index funds, bonds, CDs, as well as alternative investments such as physical real estate, whether rental properties, whether commercial or residential real estate, promissory notes, also private equity, precious metals such as gold and silver, so physical gold and silver, as well as tax liens and so forth. And of course, cryptocurrency is another popular one. So this flexibility is one of the biggest advantages of a self-directed solo 401k over a basic brokerage solo 401k provided by a brokerage firm like Merrill Lynch, Charles Schwab, Fidelity Investments, E-Trade, and even banks like Charles Schwab, Chase Bank, and so forth. Looks like we've got a question here. Let's take a look at that question and then we'll come back and go over some more information here. Let's see. Here's a question. Can a plan be drafted to allow in-plan service distributions? And if so, can I choose to only roll over 401k to a Roth IRA and leave 401k non-Roth and 401k? So the ability to make in-service distributions is determined by the contribution type. That is employer contributions versus employee contributions. And you also have the statutory IRS code regulations that come into play. So typically, there are various triggering events. For example, if you are age 59 and a half or older, that's a triggering event under the plan, meaning you can process a distribution, or you can even process a direct rollover where you transfer Roth solo 401k funds to a Roth IRA, or you convert pre-tax solo 401k funds to a Roth IRA. So that's automatically available under the plan. Now, if you want to take a distribution prior to age 59 and a half, or process a conversion of pre-tax solo 401k funds to a Roth IRA, then you have to be age 59 and a half or no longer self-employed in order to do so. However, if you've transferred IRAs or former employer plans, like a former employer 401k, a defined benefit plan, a thrift savings plan, a 457 governmental plan, or a 403b, for example, or even a pension, if you transfer those types of accounts to the solo 401k, then those funds can be converted to the Roth IRA at any time. Or you can take a distribution of those funds. Those are called income and transfers / rollovers. Don't confuse, however, voluntary after-tax solo 401k contributions as part of the mega backdoor Roth solo 401k strategy. Those funds can always be converted to the Roth solo 401k or even to the Roth IRA, regardless of your age. So whether you're age 59 and a half or older or less, you can still convert those voluntary after-tax solo 401k funds to the Roth IRA or the Roth solo 401k. Now, back to the pre-tax solo 401k funds. Those can always be converted to the Roth solo 401k as well as an in-plan conversion. They just can't be converted to the Roth IRA unless you meet a triggering event or if those funds are stemming from a income and transfer to the plan from a former employer plan or other IRAs. So good question. Let's see here. Looks like we got a follow-up question here. I want to understand where my 401k money from old employer will be parked. Good question. So here at my solo 401k financial, you get to choose where to hold your funds. So the funds can be held at your local bank, or they can even be held at a brokerage firm. A popular brokerage firm that our clients use to hold their solo 401k funds is Fidelity and Charles Schwab, for example. So we would assist you in not only drafting the plan documents and setting up the plan, but to also open up the holding accounts, aka brokerage accounts at Fidelity Investments or Charles Schwab. So we would actually fill out those brokerage forms for you. And we would help you to set up 3 separate holding accounts. So it's just one solo 401k plan, as this image here illustrates. However, you are required to separately track each source of funds. So your former employer pre-tax 401k funds would get transferred into the pre-tax solo 401k holding account, aka brokerage account. If that former employer plan also has Roth funds, those would get transferred to the Roth solo 401k holding account. So it's just one plan, but separate buckets, aka bank or brokerage accounts, to hold each source of funds. And then later on, if you wanted to transfer out those pre-tax funds that you rolled over or transfer from a former employer 401k to the solo 401k, you could actually transfer those to the traditional IRA, or you can process a conversion where you would convert those from the pre-tax solo 401k to the Roth IRA or even to the Roth solo 401k plan. And we'll actually help you to not only open the plan, but also open the various brokerage accounts. And then we'll also prepare the transfer form so that that former employer plan is transferred as what's referred to as a trustee-to-trustee transfer, which is a non-taxable movement of one 401k to another 401k, the one 401k being your former employer 401k, and of course the new 401k being your self-employed solo 401k plan. Okay, good question there. Let's see if we have some more questions here. Here's a question. I currently have a 401k that holds both Roth and non-Roth accounts. They allow distributions but require me to roll over all or nothing. I like to roll them into a plan defined held by at Fidelity non-prototype account. Once rolled over, ideally, I move the Roth account to my Roth IRA and leave both non 401k empty and preventing pro rata rules. So, number one, the pro rata rules do not apply to 401k plans. Pro rata rules only apply to IRAs. And we've covered this topic extensively on past live webinars. As a matter of fact, if you subscribe to our YouTube channel, you're going to be able to view over 1,200 live webinars that we've performed live on various topics surrounding solo 401k plans, including this topic here, as well as self-directed IRAs. So please like and subscribe to our YouTube channel. It also helps us get the word out to other solopreneurs and self-directed solo 401k and self-directed IRA investors so that they can more easily find this great information that we deliver every day on a daily basis. It would also help us to keep growing this great community. So if you haven't yet, please like today's webinar. That's of course if you like it. And then go ahead and like us across the various social platforms as well, please. So regarding your question here, you can certainly transfer the former employer 401k over to the solo 401k plan. And as I mentioned earlier, the solo 401k plan has various buckets, aka holding accounts. And that's not by accident. That's actually a statutory IRS code regulation because a 401k plan is referred to as a defined contribution plan, aka qualified plan. And it does require separate holding accounts for each source of funds, as well as for each participant. So, as I've mentioned already, your pre-tax former employer 401k funds would get transferred to the pre-tax 401k holding account. The former employer Roth 401k funds would get transferred to the Roth solo 401k holding account. And then you're going to be able to transfer those funds out or take a distribution from those funds at any time because they stem from an income and transfer of a former employer plan. Here's an example of a two-participant plan. So many times, both spouses are self-employed in the same business. And as a result, it's one plan because the solo 401k plan, just like traditional 401k plans, are sponsored by the underlying business. In this situation, the self-employed business. So it's just one plan, and both spouses are working in the business, so they would each have separate holding accounts under that solo 401k plan, also called participant accounts, to hold their various solo 401k fund sources. That is pre-tax, Roth, and voluntary after-tax funds. Hence why in this illustration, you see 6 separate bank or brokerage accounts listed, 3 for each spouse. Now, regarding the whole pro rata rule, as I've already mentioned, it doesn't apply to solo 401k plans or any 401k for that matter. It only applies to IRAs. So what that means is that, especially with the mega backdoor Roth solo 401k conversion, when you process the mega backdoor Roth solo 401k conversion, that voluntary after-tax solo 401k contribution is deposited to the voluntary after-tax solo 401k holding account. So this holding account here, you then convert it to the Roth solo 401k or to the Roth IRA. So because there's a separate holding account for those voluntary after-tax solo 401k funds, your pre-tax solo 401k bucket is not impacted because you're separately tracking those voluntary after-tax solo 401k funds under a dedicated holding account titled voluntary after-tax. And then once you make that voluntary after-tax solo 401k contribution, just the funds in that voluntary after-tax solo 401k get converted to the Roth solo 401k or the Roth IRA. So you may have to pay taxes on a small amount of earnings that accrued inside that voluntary after-tax account, because you have to convert the entire value in that voluntary after-tax solo 401k holding account. That's why you want to convert those voluntary after-tax solo 401k contributions immediately. As soon as those funds clear, so after you make that voluntary after-tax solo 401k contribution, and once those funds clear, you need to immediately convert them to the Roth solo 401k or the Roth IRA. So just the small earnings inside that voluntary after-tax solo 401k holding account will be impacted. Now, you can also transfer IRAs. So if you're trying to perform what's referred to as a backdoor Roth IRA, which of course is different than the mega backdoor Roth solo 401k, and you can actually process both a backdoor Roth IRA and a mega backdoor Roth solo 401k in the same year, but we're not going to get into that. We've actually performed a webinar on that topic as well. So visit our YouTube channel and you'll be able to access that webinar that we did solely on the ability to be able to process a backdoor Roth IRA and a mega backdoor Roth solo 401k in the same year. You can even do a trifecta where you process a backdoor Roth IRA in the same year, as well as a mega backdoor Roth solo 401k conversion, and then a mega backdoor Roth full-time employer 401k conversion. If that webinar is titled the Trifecta Roth, the Backdoor Roth, if you're interested in reviewing that webinar. And again, you can find that live webinar on our YouTube channel. But yes, if you're trying to isolate your IRA funds because you want to process a backdoor Roth IRA, let's say you have a non-deductible IRA and other IRAs, you can transfer the gains of that non-deductible IRA to the pre-tax solo 401k. You can also transfer the other IRAs, simple IRAs, SIP IRAs, to the solo 401k. They would get transferred to the pre-tax solo 401k. Now you've isolated your non-deductible IRA funds, and you can convert the basis of that non-deductible IRA to the Roth IRA. So, good question. Okay, let's get back to our topic for today, which is, can a solo 401k invest in stocks? Now, if this information is helping you feel more secure about your future or more confident, please take a moment to like and subscribe. It tells the platform this information is helpful, which helps other solopreneurs and investors, retirement investors, to find it. Subscribing also guarantees you get notifications of all of our crucial content we deliver every day to help you secure your retirement. Okay, let's see here. Here's a question here. My client wants to know when you'll deliver the 5500 Easy. We submitted your form already. Well, it's only March. That Form 5500 Easy is not due until July 31st, but we'll be following up with Form 5500 Easy forms for client signatures by April to early May? So good question there. Okay, let's see here. Another question. If my wife and I are directors on a solo 401k plan, and if I leave the company at 55, can I exercise rule of 55 without 55 withdrawal penalty? That's what I like to call a very interesting question. So typically, the rule of 55 does not apply to solo 401k plans. That regulation was written more for what's referred to as traditional full-time employer 401k plans. What is more, the rule of 55 rule requires that you essentially separate from service. So when you separate from service, that means you're no longer self-employed, resulting in having to close the solo 401k plan down, at which case you're going to be able to transfer those solo 401k funds to an IRA, or you can take an early distribution. Let me share some information regarding the age of 55 rule. Give me a moment here. See if I can easily dig it up on our website here. Give me a moment while I try to locate it here. I'm not locating it easily here, but go ahead and send us an email to info@mysolo401k.net and we'll share some more information regarding the age of 55 rule. Okay, let's keep going here. Here's a question here. What does it look like at Fidelity routinely move money from after tax to an IRA Roth? What steps to use at Fidelity platform? Good question. Let me share over a link from our website where we have the step-by-step procedure on how to process a conversion of voluntary after-tax solo 401k funds to a Roth IRA at Fidelity. Give me a moment here. Take a look at the link I just shared with you there. It's a step-by-step procedure for converting voluntary after-tax solo 401k funds to a Roth IRA. I'm also going to share one regarding converting pre-tax solo 401k funds to a Roth IRA at Fidelity. Give me a moment here while I dig that up here. Okay, I'm going to. This is a step-by-step procedure as well. It also has the information regarding how to process it through Fidelity. So take a look at those two links there. Okay, we'll come back here and monitor for some more questions here. Give me a moment here. Okay, so take a look at those links there. So back to our daily topic today, which is, can a solo 401k invest in stocks? Let me get my PowerPoint back up here. Okay, so as I mentioned earlier, a basic solo 401k plan provided by Fidelity Investments or Schwab, for example, limits the types of investments and the types of transactions that you can process under the solo 401k plan. However, you can still use Fidelity or Schwab for a self-directed solo 401k plan offered by my solo 401k financial, which will allow you to continue to invest in equities, but you will also be able to invest in alternative investments. What is more, you're going to be able to borrow from the solo 401k plan known as the solo 401k participant loan. So a solo 401k plan offered by my solo 401k financial allows you to borrow 50% of your total solo 401k balance up to a maximum of $50,000. Those are essentially IRS statutory loan rules. What is more, that solo 401k participant loan is available separately to each participant, which means that if you have a solo 401k plan where both spouses are working under that same self-employed business, that means they can each borrow 50% of their respective solo 401k funds. So of course, each spouse would need to have enough funds in that solo 401k plan in order to take a loan. So one spouse may transfer an IRA to the solo 401k plan. The other spouse may transfer a former employer plan to the solo 401k so that they can each borrow from their respective solo 401k funds through a solo 401k participant loan. And that loan is paid back with principal and interest. The interest flows back to the solo 401k plan, of course, same with the basis. And when you make that payment, which are scheduled payments, monthly or quarterly, you're going to want to make sure that you make those payments with personal funds because you're borrowing from the solo 401k plan, so you have to pay that loan back with after-tax funds. And the loan term is 5 years if it's used for any purpose. However, if you use those borrowed proceeds towards the purchase of your primary residence, the loan term can be extended to a 15 or 30-year period, payback period. So for example, let's say spouse A has a balance of $120,000 in the solo 401k. Spouse A can borrow the full $50,000. Let's say spouse B has $90,000 in the solo 401k. Spouse B can borrow $45,000 because it's 50% of your total balance, not to exceed 50,000. So under this example, total accessible liquidity would be $95,000 through a solo 401k participant loan. Spouse A borrows $50,000, spouse B borrows $45,000. So this flexibility is often unavailable or limited with other retirement account structures like IRAs. You can never borrow from an IRA. Not all solo 401k plans allow for participant loans. Some full-time employer 401k plans, actually most full-time employer 401k plans allow for loans, and you can actually borrow from your full-time employer 401k through a 401k loan, and you can still also borrow from your solo 401k plan if you have a side business, because the rules allow you to have both a solo 401k for your side business as well as a full-time employer 401k through your employer. So those loan limits are not aggregated between your daytime employer 401k and your solo 401k. Therefore, you may be able to borrow $50,000 from your daytime employer 401k plan. And then if you have enough funds in your solo 401k plan, you can borrow another $50,000. So why do most self-employed investors choose a self-directed solo 401k plan over a basic solo 401k plan? Let's go over that. So a self-directed solo 401k plan allows you to diversify across various asset classes. You also have the opportunity to invest in various types of investments, whether equities, real estate, private equity, and so forth. So you can combine stock market exposure with real estate or private deals, for example. You also have that tax advantage growth that with respect to the pre-tax solo 401k. The Roth solo 401k funds grow tax-free. And of course, you have access to liquidity via the 401k participant loan feature if you need to borrow from the plan. So instead of being confined to Wall Street products only, you can build a diversified retirement strategy across public markets, private markets, real estate investments, and other alternative investments. And you can do it all inside that one self-directed solo 401k plan. So the final takeaway regarding can a solo 401k invest in stocks is that yes, the answer is yes, it can invest in stocks. But if you utilize a self-directed solo 401k plan, it's going to allow you to invest in equities as well as alternative investments. So while still being able to use major brokerage platforms like Fidelity and Schwab for a self-directed solo 401k offered by my solo 401k financial, self-employed individuals who want full investment flexibility, diversification, and access to participant loans, they can gain that access through a self-directed solo 401k structure. Okay, let's see if we have any more questions here. Here's a follow-up question here regarding the age of 55 rule. Give me a moment here. Can you get to your question? So even if I leave the company and my wife continues to be a director on the solo 401k, I can't exercise the rule of 55? Good question. So number one, just because you're a director of a corporation doesn't mean that you're a W-2 employee. So it's important to understand that if we're talking about an S corporation or a C corporation self-employed business, in order for the self-employed business to sponsor that solo 401k, the individual has to be a W-2 employee of the business because W-2 wages is what's considered earned income from self-employment activity for a self-employed business taxed as an S corporation or a C corporation. So if you separate from service and you want to exercise the rule of 55 rule, that may be an option for you. However, the IRS could scrutinize that distribution, and items that the IRS would use to try to scrutinize your age of 55 distribution would be number one, did you set up the plan with the intention of solely using it so that you could exercise the rule of 55 rule? For example, did you open the solo 401k plan and then subsequently in the same year take a distribution due to the age of 55 rule? Or have you had that solo 401k plans for a certain amount of time and then you exercise the age of 55 rule? And keep in mind that the age of 55 rule does not mean that you're not going to have to pay taxes on that distribution. You're still going to have to pay federal taxes if we're talking about a pre-tax solo 401k distribution, and possibly state taxes. The only tax you would not have to pay is the 10% penalty that applies when an individual processes a distribution from a solo 401k plan prior to age 59 and a half. So you're still going to have to pay the federal taxes and possibly a 10% and possibly the state taxes, but not the 10% penalty. Okay, good question. Let's see here. Here's a question. So it sounds like you can choose to only convert traditional 401k to the Roth 401k. You're not required to do both at the same time, correct? You're exactly right. You can choose to convert pre-tax solo 401k funds to the Roth solo 401k, Or you can choose to convert voluntary after-tax solo 401k funds to the Roth solo 401k or the Roth IRA, or you can process both in the same year. There's no limit on the dollar amount or the number of in-plan conversions. That is, whether you convert voluntary after-tax solo 401k funds or pre-tax solo 401k funds in the same year to the Roth solo 401k plan. And many of our clients will process a pre-tax solo 401k conversion in years that their investments are down. So for example, let's say you invested in the stock market. Let's further assume that you bought Netflix when it was $150 a share, and due to the merger rumors that they were trying to, or as you know, Netflix was trying to merge with, I think it was Warner Brothers, I can't remember, but that deal fell through. So let's say you had converted that Netflix stock owned in your solo 401k when it was at $75 a share versus $150 a share. So now you can convert that Netflix stock at a lower value from the pre-tax solo 401k to the Roth solo 401k. So you only pay taxes on that lower value of $70 a share of Netflix stock. And then when that Netflix stock shoots up, let's say it goes above 100, you're going to realize all those gains inside the Roth solo 401k plan. So that's an example of where clients like to process pre-tax solo 401k conversions, is when they hold an investment that has gone down in value. You can do the same thing with other types of investments like real estate, private equity, because you can always convert an asset, just like you can always convert cash held in a pre-tax solo 401k to the Roth solo 401k. And you're going to pay taxes on the market value at the time of the conversion. Okay, I think we've come to the end of our session here. So that's it for today's solo 401k session. Thank you so much for investing your time with us. We know your time is valuable, but we feel that your retirement future is worth it. If you haven't yet, please like and subscribe if you liked today's webinar, of course, as this will help us get the word out to other solopreneurs like yourself. We'll be back live again tomorrow with more crucial content to help you secure your retirement future. Until then, have a good rest of the day.